Check it.
Welcome to Wage Cucking with JMO.
All right, guys, welcome to another episode of Wage Cucking with JMO. Today we have Max on, who is the founder of BTC2, and he's working on a new project called PV01. Max, how you doing today?
Very well. Thank you very much for having me.
Before we get started on talking about what you're working on now, you want to give the listeners a little bit of your history, like how you got into crypto and I guess a bit of what you worked on before?
Yeah, I got into crypto in early 2013, I think. I bought a bunch of Bitcoin at €7. And then they went up 7 or 10 euros. Then they went up 7x. And I thought, what the hell is this? I'm out. I sold everything, which I think is what most people would have done if they were early. I think it takes a certain kind of personality to hold all the way from $10 or less to 20,000. And so that was my essentially one and only investment in Bitcoin, because after that, when I created B2C2, I always thought that the company is going to do well if Bitcoin does well. Not that we own any Bitcoin really, but just, it's better for trading firms when prices go up, right? Because of increased volumes. And so that early 2013 was when I got into the market, was a little bit by accident, because at the time I was an interest rates trader. I was a young trader at Goldman Sachs in London. And the thing that got me the job, one of the things at least, I suppose, was that when I was a student, I coded a bot that made a lot of money trading what we now call prediction markets on intrade.com. Intrade.com may be a platform that some of you guys remember.
I used intrade.com a lot back in the day, trading prediction markets for like US elections and stuff like that. It had good liquidity, but then I think it got shut down like 4 or 5 years ago.
It was awesome.
I was an intrade as well. I was doing forgot if I did politics, but definitely did the one you could bet. Wasn't it that where you could bet on whether or not there would be like a dirty bomb detonated in a major city?
Yeah.
There was a lot. The biggest contracts were politics, and whether the S&P was going to be, or the Dow Jones, I think, was going to be up or down. Those were the most traded contracts. And yeah, I was like a 19-year-old student, and I had an internship at Google where they worked on prediction markets, and I thought, holy shit, maybe I can do something like that in the real world. And I did. We made quite a bit of money, especially for a 19-year-old student. And so that's what got me, other jobs and especially as a trader. And because I was a student and I really liked to party, it was all automated. All automated because I wanted to have time to myself. And surprisingly, when I told my manager at Goldman Sachs, because I just wanted that to be out in the open, that I was doing that automatically on the side, they went, the fuck is in trade? Yeah, sure, fine. They had no idea. So I thought, well, I'm not going to ask twice. I got that implicit approval. So I kept doing that. But in trade went the way of crypto in a way, because you could trade also gold, up-down contracts, gold digitals, I think, and a few things. And so the CFTC stepped in at some point and said, well, you can't offer the product to Americans. Because crypto wasn't the first Wild West. In trade, anyone could trade on that, even Americans. And I mean, really, you were trading what was obviously derivatives on the price of commodities and other things, even the Dow Jones. And so on that basis, those things were under the purview of the CFTC. So the CFTC actually wasn't so nasty there. They just said, you have to stop offering to Americans. I don't think they levied any sort of big fine. It's just actually we found that this is not okay for the US, so please stop offering, which they did. The problem was that 80% of the business was Americans. And so in trade around 2012, I think, started losing steam. Some others tried to replace it, but it never really took off. And in the end, something happened that also prefigured some of the events in crypto. The founder of InTrade died climbing the Everest, or so we think. And then his wife told a little bit like what's his name, Gerald Cotton from Quadriga CX.
Yeah, he died in India, right?
While his dog is sitting on millions of dollars. Uh-huh.
So that happened within trade. And I was very lucky to get all of my money out, also in a dynamic that helped with crypto. You know, they tried to get everyone who had big balances on InTrade to contribute to the losses, to do socialized losses, essentially. And I said, well, by law, I'm entitled to my money just as everyone else. And so the day that you open up withdrawals, I'm going to ask for the entire withdrawal. And if any of the suckers are willing to contribute to socialized losses, that's good for them, but I'm not going to do it unless you want to have a conversation around equity or things like that. But they did not. They did not. So I had put in my withdrawal really early, and I thought it was going to be, you know, first in, first out. And yeah, I got all my money, which was a good outcome in the end. But then I ended up not having that passive stream of income that I really enjoyed. And so what happened is that my flatmate at the time, who was a quant at Goldman, he told me, hey, you should look into that Bitcoin thing. It's pretty new. And with all your automated market making, maybe there's something to do there. So that's one of the many links between InTrade and crypto. In fact, a lot of the people in InTrade are now in crypto. There's a Ron guy, I think he went to Augur or something like that. I don't remember his exact name. And a lot of the investors in InTrade were actually quite prominent. There was Drucken Miller and a bunch of others. And so that was, to me, InTrade.com was like a testing ground for what happened to crypto. But anyway, then I plugged the algorithms into Bitcoin, and that's when it started. That's when B2C2 really started.
I see. So yeah, so it's funny you bring up Augur because I was one of the original users of Augur, and I thought that I thought it was like a fantastic idea at the time, like utilizing the Ethereum blockchain, have like a peer-to-peer market for prediction markets. But I'd say it's probably one of the bigger failures, I'd say, in like the whole, I think it came out like 2016, like the previous bull cycle, when like ICOs were booming, and there was like limited development on Ethereum, but there were some like legitimate products in their infancy. And I felt Augur was, you know, like conceptually a fantastic idea. Do you have a take as to why like it basically failed in like capturing any market share? I mean, in my eyes, it like blockchain technology, especially Ethereum, is built for products like Augur, but maybe it was like too early to the market.
I agree with you, first of all, that it's a real shame. And secondly, yeah, it was too early. I remember meeting I don't remember his name, you know, the Augur guy in London 2015, was already working on it. Yeah, Joey Quick. Yeah. And it was simply too early because I don't think there was a critical mass, yes, of people who have Ethereum and who are, you know, comfortable using their wallet to participate in something like Augur. That was before MetaMask and a lot of that stuff.
Yeah.
So a big problem of user interface, I think. Also, perhaps the desire of the general population to gamble on a variety of things seems to ebb and flow, and maybe they were not on the crest of the wave there. But it gets you. I mean, it makes you wonder. I mean, I guess it still works. It's still out there.
Yeah.
Why is it not taking off now? Maybe there's actually a design problem. I have to admit, I looked at the website a couple of times. I've never actually used it.
If you ask Paul Stortz, he said, I remember I asked him about Augur a long time ago. He said they tried to steal his design, but they made modifications that only made it worse. So we'll see if Bitcoin Hive Mind ever comes out. We'll be able to see how true that is, that statement.
Yeah, it's pretty interesting because Augur initially was, I'd say, like the first use case for Chainlink and like on-chain oracles, because you set prediction markets. You need some oracle feed to confirm, you know, what is the outcome of a certain prediction market, because it's not based on like it's not based on like consensus or popular vote. It's based on like a legit real world outcome. So then like I was actually pretty bullish at the time for both projects, because it made sense, right? You set up these prediction markets, and then you have an oracle feed to like saying, like for example, if you have a prediction market for the S&P price, you get like an oracle feed that spits out the S&P price, and then you can settle the market instantly, and like the peer-to-peer traders can get their funds instantly. So it seemed like, at least in my eyes, a reasonable design for a market. But yeah, like in my opinion, the biggest issue, I guess now, but like in the past, was there's like very little liquidity. It's like not popularized. And if there's no liquidity in these markets, like it's sort of a self-fulfilling prophecy, right? If there's no liquidity, no one's going to use it, and if no one uses it, there's no liquidity. So it didn't have that initial push, that initial user base that provided like a heavy layer of liquidity for more and more users still on board.
Could it be that the economic design also was a bit flawed? Because I seem to remember now that so intrade.com had a really good design where you had an order book and anyone could submit orders. And then Augur, I think, was using some concept that's sometimes called pari mutuel, I think, where it's a little bit like a Uniswap type setup where the more money you put on one side, the more it pushes the price. But of course, it's kind of, I think when you want to do a bet and you've used Intrade, you want to be able to just submit an order, set a price, rather than come to a pool where it's kind of unclear the way that the market moves around. Also, how are you going to be able to exit? I think that's quite a complex setup. I'm sure intellectually it's fascinating, but
from a market maker, it's you want to bet fair. They had trade fair as well, right? You want to sit there and you want to market make at like you want to choose your own prices, your own odds and market make.
It was basically like the difference right now in like a central limit order book, where you can put limit orders versus like the automated market maker model that like Uniswap and the other decentralized exchanges. But basically you're quoted a single price, and the price fluctuates based on like the volume and how many people are on each side of the bet. So like, if you're a market maker and you can't put in simple limit orders, it sort of turns you off to the platform entirely.
Yeah, and I think that so Uniswap, I was skeptical at the beginning, and I was totally wrong on that. I thought that a system like that with a market maker where the formula because it's automated and it's public cannot work. But clearly, it's been working for shitcoins. For shitcoins, it's good because. What the alternative? The alternative is not having a price. And so even though that's not the best price, for an asset that can, go up 20x, I guess people didn't mind so much the fact that every little transaction maybe wasn't done on the most efficient terms. And so I think that was quite an interesting innovation on which we built a lot of stuff. We really should be grateful to the guys who first launched the first automated market makers, because that really enabled a lot of projects to get off the ground. Shitty projects for sure sometimes, but also interesting ones. And that's something that I figure we should reuse. Also because, and a quick segue here, we've obviously entered a phase of the industry where the authorities in the US are really not favorable to what we do, and we need to find ways that we can keep operating while being decentralized enough that they can't come after any single one of us, and that we don't actually control what happens in the background, because that it really exposes us to the long arm of Uncle Sam. And so I think that some features of DeFi are going to be quite important in the future. I used to be also kind of skeptical because I thought, it's a money laundering cesspool and things like that. I've changed my mind on that as well. And I think DeFi is going to be more important now than ever.
Yeah, I think the automated market maker model worked really well for sort of newer long tail assets, especially like newer tokens that, I mean, at least at the time, it was difficult and costly to get exchange listings for your tokens. And obviously, if you release a token, you need some form of liquidity for the token holders and the people that want to acquire tokens. So like even though it's like sort of a basic model, and a lot of the times the actual liquidity providers are kind of being exploited by the design of the pool and then the traders of the pool, it worked for quite some time for at least some assets. And I think today, like I'd say long term, it's probably not sustainable for larger cap assets. It makes sense for assets that are sort of supposed to be on peg or 1-to-1. So if you have like a concentrated pool of like say USDC, USDT, like a Uniswap pool makes sense. But if you have like Bitcoin, Ethereum, where both assets fluctuate. I don't think the automated market maker model makes sense compared to like a traditional order book. Yeah. So moving on, I wanted to ask, like before your time at B2C2, or I guess in comparison to your time at B2C2, you worked at Goldman. Were there any like noticeable differences you noticed immediately within the crypto industry versus the traditional finance industry?
Well, first of all, my colleagues at Goldman were a lot of them were quite rather favorable to crypto. They could see the benefit. They could see the intellectual aspect, the innovation of bridging hashing functions and cryptography with a sort of economic virtuous circle to support the security of a decentralized network. So I was, I mean, in fact, the smartest guy I worked with thought it was kind of cool that I left my job to do that. But of course, there were big differences between crypto and traditional markets. But actually, I don't think that the traditional markets were necessarily much smarter. I think that everything that was interesting in TradFi was reasonably quickly adopted in crypto. And there's also a lot of stuff that's useless in TradFi that we did not adopt, and that's a good thing. I think you have to realize that there's a path dependency to the evolution of a market. So depending on the early beginnings, there's only certain outcomes that are achievable. And because of sometimes network effects make it so that a certain institution has very strong staying power, and even though it's not efficient, you can't really move away from that, from different types of setup. And so in the end, the path that we followed in crypto, I think was quite good. And I'll make a few parallels. First of all, things that were quickly adopted in crypto, like in TradFi, and you see the same evolution with Robinhood, right? So there's like an iron law of trading, which is that how an asset trades on what venues is almost entirely predicated on the sophistication of the traders on the other side. So when you have the most sophisticated traders, the high frequency trading firms, the quantitative trading firms that have an ability to predict short-term price movements, then the market makers don't want to face those guys. They don't want to be on the other side of those guys because they know that they're going to lose. And so essentially, those guys end up going to exchanges, anonymous multilateral platforms, where they just trade, everyone against everyone, the sharks with the sharks. And so if you're not one of those very sophisticated traders, if your activity doesn't move the market or is not predictive of market direction, then you ought to go directly to a market maker. And that's what we call OTC trading, which people usually thought meant big trades, but actually it doesn't. OTC trading is really about doing the millions of small trades from typically retail users or institutions that don't predict short-term price movements. Maybe they're just like long-term investors. And those guys go directly to the liquidity providers because they just get a better price. They get a better price because when the liquidity provider trades against a less sophisticated player, they know that the market's not going to move, so they're able to give them a much better price. Mm-hmm. And what you find is that over time, there's a clearer and clearer separation between the sharks that all end up on the exchange and the retail users and non-toxic traders that end up trading directly with the market makers. This is also what you see. I mentioned Robinhood. Robinhood is exactly that. In the US, historically there's been a high propensity for retail traders to trade on the exchanges directly, but that stopped making sense as that became more and more expensive in comparison to the alternative. The alternative being Robinhood and other brokers, which started realizing that if they brought those flows directly to the liquidity providers, such as Citadel, they would get paid for doing that because Citadel had a preference for trading with those rather than on exchange. And as a result, because they would get paid, Robinhood, they could offer zero commission trading, et cetera, et cetera. The US market is a bit complicated because the SEC has all sorts of strange rules that make the market what it is. But in the end, you have to consider that Robinhood really is in the business of aggregating retail flow and then giving it to the liquidity providers to achieve better outcomes for the retail traders. Whatever you think of of the COVID bubble and the meme stocks and all that stuff, it is the case that those innovations have significantly reduced the cost of investing for retail investors.
Mm-hmm.
And it's a similar story in crypto. The big retail brokers, of which Robinhood is one, that's what they do. They also go directly to the market makers. They tend to be some of the biggest clients of the market makers. And you start seeing exchanges become more and more toxic in terms of the flow there because of that continuous separation between soft flow, as we call it, and toxic flow.
Mm-hmm.
So that's one of the big commonalities between crypto and TradFi. In fact, at B2C2, that's one of the first things that we did as early as 2017. We went to Japan because we knew that Japan had a very big contingent of foreign exchange retail traders who we thought were going to be perfect in the context of crypto. I mean, they were going to want to trade crypto. And the big retail brokers already existed in Japan: GMO, Hirose, SBI. And so those guys were going to want to trade directly with liquidity providers. So that's one commonality. Now, differences that you have is, to this day in crypto, we don't have central clearing, but we do have a lot of credit extension. So central clearing, meaning that instead of facing the exchange, facing Binance or Bitstamp directly, you trade on Bitstamp and Binance, but then once a day, your trades go to the clearinghouse, Euroclear, LCH, DTCC, there's a handful. And that's where your trades end up being settled. It never worked for crypto because and there's a path dependency there. When you think about it, when you have a clearinghouse, you don't have any settlement risk in the sense that you can't send your money and not get the counter value back. You can't send your dollars and not get your Bitcoin back because that happens atomically at the clearinghouse. However, you do have a bit of credit risk because between the time that you trade and the time that stuff settles, how do you make sure that you're still good for the trade? You know, if you buy Ethereum at 2000 and then it goes down to 1500, why would you settle that trade? And in traditional finance, that's solved by everyone leaving a bit of collateral at the clearinghouse so that you don't pay, they just liquidate you. But in crypto, you couldn't do that because crypto is from its early days, has always been a retail market. And if you go back to the days of Mongox or MTGOX, it wasn't possible for Mongox to say, hey, guys, we're going to just settle in 2 days. That sounded crazy. On Mongox, when you sold your Bitcoins and you got your euros, you wanted to get your euros out of the system immediately. Like on eBay. You know, on eBay, when you sell something, I mean, you get your money and that's it. And so if you trade your magic cards on MTGOX, then some sort of settlement delay, that doesn't make any sense.
Yeah.
You're being very generous. I was going to say it's because you need your heroin right now.
You know, like people are going to do whatever they want to do with their body, and whatever buyers you erect, they're going to find a way around them. But yeah, on Mongox, the exchange had to enforce that everything was pre-funded, and that's the only way to take care both of the settlement risk and the credit risk in between the trading and the settlement. And so that's how we've evolved in crypto. Still to this day, essentially everything is pre-funded, except the platforms themselves provide leverage, which is quite important because that makes that give the exchanges and the liquidity providers a very specific position in the system, because they're the ones offering the leverage. So it's at the same time pre-funded in the sense that every time that you buy or sell something, you're able to take your money out immediately. But at the same time, you're offered leverage, whether it's like cash leverage in the sense that it's leverage to trade the actual physical crypto, or it's perpetual swaps or things like that. The platforms themselves provide a lot of leverage. That's a big difference between traditional finance and crypto, because in traditional finance, the settlement system and the provision of leverage are different. I actually think that it's a bit more efficient in crypto. However, it gives rise to a sort of conflict of interest in a way that has revealed, I mean, that kind of crystallized a few times in a very dramatic fashion. In fact, in one of those cases, I was a party to the problem, which is that the platform, when it's the one providing the leverage, then if a client blows up, it's the platform that's left holding the bag.
Mm-hmm.
And the platform, most exchanges are supposed to be neutral intermediaries where they just match buyers and sellers. But when they provide leverage, they're not neutral intermediaries anymore, because if one of the clients blows up on margin, then they're the ones left holding the bag. And that also goes back to the question of, it's similar to when exchanges have their own market making teams. It's also kind of similar idea. You're trading against the clients. Sometimes it's disclosed, sometimes it's not, but at the same time, it means that the more money your clients make, the more money you lose, and vice versa. I mean, it can be done the right way, but I think it's always, I mean, it can be a little bit murky. And so those are some couple big differences between TradFi and crypto. And I'm going to stop there because I've been rambling for a long time.
No, it's all right. I was going to ask, like, from the institutional side of things, and like, I know you have a background in traditional finance. How do you see like the current state of the markets in terms of, like, are there big HFT funds that, like, let's say in the past like 6 months to a year have moved to putting in volume in the crypto markets, or are like the instruments in crypto a bit too primitive now for like the big funds, like the bigger organizations to really dive in, and like it's mostly retail? Like, how do you see that?
Well, no, for crypto is one of the most efficient markets in the world, in my opinion, in terms of trading. In fact, most of the frictions don't come from the trading side; they come from the settlement side. The fact that several banks in the US have blown up who were banking crypto companies, and so when there are price discrepancies, when there are inefficiencies in crypto, it's typically because of something unrelated to the trading itself. It's always related to the pipes, or most of them related to the pipes, related to friction from the banking system, from regulators, etc., etc. When you don't have those frictions, the market is super efficient. In fact, I think if you want the best example of that, it's when BitMEX's perpetual swap, when it became popular. They invented it a long time ago, I think 2014 or 15. In fact, one of my big regrets in life is Arthur Hayes asked me in 2014 or 15 to make markets on BitMEX against equity in BitMEX, and I said, I'm sorry, I'm very busy. That was a bad mistake, very bad mistake. Well, I mean, we ended up doing it, but we said, we don't need incentives. We're just going to make it because we make money. That's fine. Really stupid of me. And so, but that product took a couple of years to take off. But when it did, it became so incredibly efficient. I think it blew everyone's mind that BitMEX swap was always trading one tick wide, like 50 cents wide, in enormous size. And that's because it was designed in the most efficient way possible. You can have a ton of leverage. It didn't rely on any banking pipes. You just deposited Bitcoins, and that was your collateral. The mechanism for bringing it back in line was also reasonably good. And the volumes became so big that all the big HFT market makers came to trade on that platform. Tower Research, Jump Trading, as I understand, even XTX, all those big TradFi market makers came to trade the BitMEX swap. And you got that incredible liquidity there, which just goes to show that the Bitcoin market, even though no one really knows what the undervalue of a Bitcoin is, I mean, is it rainbow chart? Is it cost of mining? Who knows? But just the flows, the buying, the selling is enough to give you an extremely tight market with really big size. If you do that, and you don't need any regulation, any banking, any whatever to get there. So it shows you that the sort of the natural state of a market left to its own sort of competitive devices is actually quite efficient.
Yeah.
It's actually quite efficient. The competitive pressure to offer better prices is very strong. And as a result of that, I mean, we all know now that all the big HFTs are in crypto. The ones I mentioned, Tower Research, also Hudson River, they're all in crypto because there's money to be made. So on the one side, you have a less sophisticated, like a non-institutional user base. I mean, it's you, it's me, it's just normal individuals.
Yeah, just retail, like the large retail base.
And they're facing very sophisticated market makers who, due to competitive pressures, give them extremely good prices. And all of that, when you consider who's really making the money there, it's the exchanges. The exchanges themselves are making the money. And why? Maybe because they operate some of the most difficult functions, the KYC, the banking, the dealing with regulators, the
Yeah.
corporate structures, offshore and onshore.
They
That's
also have to handle
really,
like custody of funds, like user
yeah,
deposits,
the
figure out.
trading.
Yeah.
Yeah, and so they're really the ones doing the heavy lifting. I mean, electronic market making is it's hard, but at the end of the day, anyone with an idea can come up with a better algorithm in their garage. I mean, more or less. Now you have obviously barriers to entry, but historically it was like that. And so yeah, the exchanges are capturing the bulk of the profit. It's no wonder that people only talk about Binance, Coinbase, and others in terms of the big players in our industry, and you very seldom hear of market makers. And in fact, the only reason that you can hear about a Wintermute or a Jump is because they have very big venture arms.
Hmm.
They invest in projects,
Yeah.
and so they're kind of part of the ecosystem like that. But if they did not, I don't think that most people would have heard of those names.
Uh-huh. Yeah, that makes sense. So moving on, I wanted to talk a little bit about your new project, PVO1, which is a blockchain debt capital market. You want to talk a little bit about eventually what it's going to do and what you're looking to accomplish?
Yeah, yeah. It's one of the things that's missing in the crypto market that exists in TradFi that we really have to replicate is the fact that we don't have bonds in crypto.
Hmm.
We have equity tokens, the ICO tokens, but we don't have bonds. And so the ICO tokens represent, or the governance, whatever you want to call them, they represent the ownership of the an app or a company. But then on the debt side, we don't have anything that's good. And I think there is a natural skepticism in crypto when it comes to debt, because in a way, crypto was also a more philosophical movement away from the concept of debt in the sense of fractional reserve banking, which is in a sense, banking based on debt, the subprime crisis, the bailouts of banks who had too much debt. But I think that not all debt is bad. And when you there's a saying in French, which is that when you chase the devil out the front door, it comes back through the back door. And the debt in crypto has always existed, even if we didn't call it that. But when you offer 50x leverage, what you're offering really is collateralized debt, debt collateralized by whatever you're purchasing. And we know that leverage in crypto has been one of the defining features of the market. So debt is always going to exist, even if philosophically we don't really like it. And I myself always wanted to buy my house mortgage free and all that stuff. I don't really like debt myself. I think that's a great way to lose a fortune is by adding leverage on top of your existing fortune and getting stopped out. So even though we don't like debt, we gotta have debt. That's just what it is. And in fact, the safer the business model, the more debt should be in the system, just economically. Because you look at a pharmaceutical company, they don't have debt because, like a pharma startup, it's like a coin flip if they're going to be successful.
Yeah.
And so a debt investor doesn't want to bet on a coin flip. So pharma companies don't have they only have equity. At least not the big ones do, of course, have debt, but the small ones don't. But when you look at an industrial company, they have a ton of debt because it's very easy to predict how much money they're going to make. Well, you put iron ore in and you get steel out. How complicated can it be? You can lever that up a lot. And if it fails anyway, you've got assets, you've got tangible assets that you can take. So in crypto, a lot of business models are actually reasonably safe. So we want to have a lot of debt. Now, where that's failed is at the junction of people thinking that a given business model is safe or actually it's really not safe. So three arrows were supposed to be those geniuses that always made money. And in fact, the way they made money in TradFi, because they were known in TradFi, was arbitraging between different banks on some emerging market FX products. And so a very safe business that they also levered up a ton because the banks gave them a lot of leverage to do those little arbitrage. But in crypto, they started venturing into less risk-free stuff, especially the the big GBTC premium trade. So
Yeah.
Mm.
The GBC ARB.
Yeah,
The trade that has killed many before them and will kill many after them.
the
It's like
Widowmaker.
it's a graveyard.
It killed me as well. I bought
I'm sorry.
at a 20% discount, and I thought I was a genius for doing that. And it's like a 45% discount now. I should have been more patient. Yeah, the Widowmaker there in 10 seconds. So GBTC is that sort of pseudo ETF that tracks the price of Bitcoin, and you can take some Bitcoin there and receive shares in return, but then you can only sell the share 6 months later.
Yeah.
And so people would take Bitcoin, bring it to the ETF sponsor, Grayscale, and then they would get shares. They would wait 6 months and then sell them. And the thing was trading at a huge premium because it was essentially the only like tax-free IRA compliant way to buy Bitcoin. But then
I was going to say it also allowed for like a lot of people that don't know how to handle Bitcoin, like don't understand self-custody, to invest in a Bitcoin product through their IRA, through their brokerage or whatever, and have exposure to Bitcoin. So so for a while there was a lot of demand for it because people wanted exposure to Bitcoin, but they didn't know how to hold physical Bitcoin. So they put IRA money into it or brokerage money into it, and it caused a huge premium, which has since evaporated.
Yeah, and also there's a ton of investors out there who are only allowed to invest in certain classes of things. They can't just like go buy BTC.
Yeah.
So yeah, it makes sense.
That premium existed for a long time, and 3 Arrows started making it. But then there was no real reason there should always be a premium. And at some point, people did that trade too much, and the premium turned into a discount, leaving 3 Arrows and others with massive losses. And that levered that strategy so much that there was a $1 billion bag, essentially, a $1 billion bag that was left in the hands of everyone who had lent money to 3 Arrows. And that was quite an ecosystem. Genesis, biggest lender to 3 Arrows, the likes of Celsius also. And when you compounded that with the failure of Luna, which also really hurt the treasuries of many crypto firms, then we entered a proper credit crunch. Because if 3 Arrows, maybe the poster child of sophisticated crypto trading, could go under in such a dramatic fashion, then no one is safe in a way. And the problem that PVO1 is trying to solve is that the fact that 3 Arrows and others had borrowed so much, and who had lent to 3 Arrows, there was no transparency around that question. So we didn't know how much 3 Arrows had borrowed. In fact, some people who lent $100 million to 3 Arrows woke up to realize that 10 other players had done that. And that 3 Arrows were not borrowing, $100 or $200 million, but billions.
And they had posted the same collateral multiple times.
Yeah,
is that true?
They were. I mean, I think at least they were recycling collateral, right? So like they're essentially leveraging their leverage like repeatedly.
Yeah, and there's two ways. There's two ways to provide collateral. Either you send the collateral, in which case you can't really send it twice. I mean, it's Bitcoin.
Yeah.
At least that's fixed that. You can only send your Bitcoin once, no double spend. But the other way is when the asset cannot easily be moved, you sign a piece of paper saying, hey, I keep this aside for you.
Yeah.
You're pledging it. It's called a lien. I mean, there's different ways to call that. But I mean, typically, you're supposed to put in the document that you only pledge it once. It's possible either people overlooked that and that wasn't present in the documents, or that they simply lied. That's also possible. In which case,
I've seen some of the documents from 3 Arrows Capitals, and it was basically like, we have $4 billion, signed Kyle Davies, and then people accepted that as collateral, like a piece of paper that said that.
Yeah, I hope that the GBTC shares were at least not pledged more than once. I mean, Genesis is famously the bag holder for those, and it's not really kind of allowed to sell it easily, or at least, I mean, there's a massive discount now, so they're facing a massive loss. I mean, that's why they're going bankrupt. I mean, they are bankrupt, I think, at least one of their entities, supposedly. And so, not only did we not know how much debt 3 Arrows had, but also who owned it. We suspected Genesis, you could suspect some FTXs, but really for 6 months between, let's say, like May 2022 to November, the failure of FTX, everyone was wondering where the skeletons in which clauses the skeletons were. And the reason that we don't have that transparency is because we don't use a very simple concept, which is a concept of a bond, a debt security, which is the same thing as an equity token, as an ICO token, except it represents debt. And that stuff works really well in TradFi, and we ought to have it. I think one of the reasons we don't have it is because we started with the stuff that's the juiciest, that moves around the most, that pumps the most, and that's naturally going to be equity, because of equity representing a residual claim on the value of some company or other. I mean, obviously, it's more exciting to trade stocks than to trade bonds, but now we really need those bonds. You really need those bonds, and also that could be a catalyst for another sort of bull run or excitement around crypto, because people have grown sick of trading ICO tokens, and they've grown sick of trading altcoins, or at least alt season is not live every day, right? I mean, it comes and goes, and so to have bonds now, I think would be interesting. It would solve other issues or contribute to mitigating some issues at least. I mean, I'm sure some of us here, we own some, we have some balances on either FTX, Genesis, others that went bankrupt. And if you want to, or even Mongox, I mean, I'm still waiting. I'm going to get my money soon. I think. Andreas, you as well, probably.
No.
Okay.
That was no FTX. The signs were there. You were just, I know what happened, because there was so much money to be made from arbing. You probably just wouldn't let it go.
Yeah. But
I was out the door months before you got erected.
Good on you. I at the time was the number 2 biggest market maker on at least volume player on Mongox. So I thought
who was number 1?
I don't know, because the way I know, by the way, is because a lot of
Mike Komaransky?
I don't know, but their database was leaked, and my user ID was at the top there, but it's just a UUID, it's just a UUID, like my API key or something similar.
Just like a bunch of numbers, right?
Yeah, just a bunch of numbers. And so I don't know who was number 1. I don't know. I wish I did. It could have been Mike Komaransky that but so I felt I had to be on the platform. I had to maintain balances there. And so the problem with those stock balances is that in order to monetize them and to get out, it's a convoluted process. I mean, if you have millions of dollars of it, you're going to find someone to buy it from you. That's what Fortress and 507 Capital did with Mongox. But then again, they came in a long time later. They didn't come in immediately when the thing went belly up. So even if you have $5 million on Mongox, you can sell your claim, or you could until recently, I guess, because it's resolving now, to Fortress for some percentage of its value. But if you had like $10,000, forget about it. I think maybe Fortress managed to automate the setup a little bit, but there's a threshold under which you're kind of shit out of luck. And same thing with FTX and everyone. There's kind of a market. Funny enough, as you know, what's it called? OPNX, like 3 Arrows guys are looking to create.
We're actually having Leslie from OPNX on like in a week or so to talk about that'll be interesting for sure.
That's going to be a very interesting conversation. So in those contexts, there is a market, but it's not really liquid. You need to sign a lot of paperwork. The buyers also need to be sure that they're actually buying the thing, because someone comes to you with an FTX wallet. How do you trust that if you sign the paperwork with them, you're actually going to be the ones owning the thing at the end of the day in bankruptcy? So it's not great. If instead, when you lend to a company, instead of having some bilateral loan, you have a token that represents the debt, and whoever owns the token owns the debt, then it would be much simpler to take the token and sell it to someone, just in the RC20 token or something like that. That would make that market, even in bankruptcy, of claims on crypto companies a lot more efficient, and people wouldn't have to wait years to get their money back. So those are some of the problems that PV1 solves by going to issuers and issuing debt as tokens, and then getting investors to buy those tokens, and afterwards trying to maintain a secondary market in those debt tokens,
Uh-huh.
then we should make the way debt works in crypto a lot more transparent and efficient.
I see, I see. So yeah, I wanted to talk about like the specifics of the platforms. So it's going to be on chain, right? You're going to be using, let's say, Ethereum blockchain for the transaction of these tokens. So how exactly does the debt tokens work? Like, for example, if there's like an institution or a group that like has a decent amount of debt, are you going to issue, say, ERC20 tokens where like one token equals $1 of debt? Or are they going to be like individual tokens per person with like varying, almost like NFTs, I guess, in a way, but like which one would you use to represent debt on the platform?
It's a good question because a lot of players are doing that, and some of them are doing well, like Ondo and others. They're doing that with treasuries, which we also want to do, but that's not our core focus. Our core focus is not actual companies to issue the debt, not just US government debt.
Yeah.
But so what they're doing is that you invest in a pool, or it's kind of same idea with Maple. You, instead of buying something directly, you invest in a pool, and then someone else is responsible for buying assets into the pool. And when it's US government, that's fine, because one treasury bond or another, do you really care? Maybe you care a little bit, but it's not such a big deal. Whereas if there's a pool in which you can invest, and the pool buys debt from B2C2 and Binance and some known and OPXN, then I'm not sure that everyone wants equal exposure to those three names.
Yeah.
Maybe you trust OPXN, but you don't trust B2C2. And so when you have credit sensitive instruments like corporate debt, then you want to make your own decision. So the concept of a pool doesn't really work. So instead, the token itself represents one bond. And think of it, I mean, we got to start with ERC20 because that's the most accepted standard. So think of it as an ERC20 token. Every bond is an ERC20. Let's say it's $10 million, so there's 10 million of balance. It's infinitely divisible, so it doesn't really matter. And then what's quite important is beyond the fact that it's so 1-to-1 compared to an actual, like it's an actual bond with an actual issuer, it's not a pool, is that the thing is transferable, and that's key. The thing is transferable. If it's not transferable, it's not a bond.
Yeah.
And I think that a player like Ondo has made the design choice that it wouldn't be transferable so that it could be accessible to US qualified investors. So our stuff, if we make it, I mean, the way we made it very broadly transferable, but then of course, we're not going to be able from the beginning to offer that stuff in the US.
Yeah.
Because it's a trade-off. Either you're flexible and you don't touch the US, or you touch the US, but then you have to be inflexible.
But like hypothetically speaking, couldn't someone just acquire these tokens on chain without doing KYC and bypassing the whole like US offering thing?
Potentially, let's say you end up having some sort of Uniswap pool for one of the tokens, and if the token's an ERC20 token, you can't stop, like you can't put a stop to the transfer function of the Ethereum blockchain. You sell it where you want to sell it. Now, whether that constitutes a legally valid transfer is another question. What does it mean to be legal? And that's obviously some of the secret sauce is that, how can you have, I mean, given you can't really stop people from transferring the asset, what does it mean? I mean, some transfers clearly are not valid in some sense, either economic or legal or compliance or something like that. How do we make those two things work together? But when you consider what an actual bond is, a bond, you can also send it to whoever you want. So bonds historically, and actually still to this day, are just a piece of paper. And who owns the paper owns the bond.
Yeah, it's very archaic.
It's also the premise of I believe Trading Places, a few other movies.
Yeah, Die Hard. They're stealing some paper bonds.
No, sorry, not Trading Places. I had confused that was commodities trading, but Die Hard for sure. It's raining bonds.
A recent Netflix series, Kaleidoscope, also same idea. And so that's what bonds are. And interestingly enough, I mean, in an obvious way, bonds are kind of electronic now. I mean, we don't really use paper that much. However, the way it kind of works in legal practice is that Euroclear gets some sort of PDF, they print it, they put it in a vault, and that's the bond. But they print it. They actually print it.
I love that. Max, I got a question. So with a bond, how does the payment work? How is it just if I have to guess, I'm guessing on the ERC20 contract, it keeps track of repayments and you go and claim it. That's how I would make it.
Yeah, that's a very good question. In TradFi, how does the payment work when normally you have the bond, and you know why we call the interest a coupon? You call it a coupon because your piece of paper would have like 10 different coupons, and
yeah.
by the time you would tear it off, go to a specific bank that was responsible for that one bond, and then they would pay you your money. Then that became a little
it has
bit
the date on it?
Yeah, there's a date on it. Yeah, you're supposed
okay,
to. Yeah, you can go to the bank with the coupon at some date and get paid. And so if someone steals the bonds with the coupons, then you lose the bond. Then it became a bit more electronic. But at the end of the day, when the issuer makes a payment, they make the payment to Euroclear, the actual legal owner of the bond. And then Euroclear, it has some clients, maybe like call it 30 people own the bond. It sends the money to the 30 clients. And then the 30 clients themselves have sold the bonds to others. They're kind of holding the bonds on their behalf, and then they have to distribute, kind of like staking as a service, if you wish. You know, like you go to Kraken, you stake your stuff, and then they pay you whatever share you're owed. And so that's how it works in TradFi, which kind of makes it a little bit complicated when you think about it, because you have to find the ultimate beneficial owner of the bond. And there's also some tax rules. I mean, a lot of stuff comes into play. Whereas on the blockchain, on the public blockchain, you can just go and, either airdrop or claim. Yeah.
Claim for sure.
Yeah.
Then you don't have to pay then the issuer doesn't have to pay the gas fees. But also I think it's more elegant, but okay, we don't have to get into the tech.
I'm with you. I like claiming more. And in fact, I can say
I think claiming makes a lot more sense. Like it's a more simple solution.
Absolutely.
Yeah, and we use claiming. Just because it's kind of cool to be able to airdrop. People can just like buy and forget a bond. But the airdropping is extremely costly, computationally speaking. So that's not the best. But I kind of like it though, because the problem with gas fees is that when you're going to claim something, it's going to cost you $5. Whatever you do is going to cost you $5. And our desire is to make, fixing some problems with credit in crypto is nice, but the real objective is to make fixed income investment accessible to as many people as possible. And so if you've got $1,000, we want you to be able to put it at 5 or 10% in some sort of fixed income product. But then, that means at the end of the year, you're only going to have, call it $50. If you pay 10% of that just in gas to claim, that's just not the best outcome. But I guess that's one of the constraints that we face, and one reason that we're very open to, after implementing on Ethereum, working with other blockchains, which might have better fees and things like that.
I was going to ask, have you considered looking at like a few Ethereum rollups that, or maybe even developing your own rollup for this specific purpose, where you can consolidate all the transactions on one rollup and pay like a fraction of the fees, and then eventually you get more like lower end retail users that you can't really afford to make Ethereum transactions regularly be able to use this rollup for their needs?
Yeah, so I don't think we're smart enough to do our own rollup, to be perfectly humble and honest. So I think others are much smarter than us. I've rollups, and so yes, I don't know yet which blockchain is going to be number 2. At the moment, the product is like works in terms of tech on the Ethereum blockchain. But whether it's going to be Polygon or Avalanche or Polkadot, that I don't know yet. But my objective is to be essentially agnostic. I think it's very negative in crypto how people are trying to bring other projects down.
I agree. It's very tribalistic right now.
Yeah, you want to go where the users want to go. Yeah. And if the users want to go with Avalanche, it's going to be Avalanche. If they want to go with something else, it's going to be something else. I think it's really silly to say, oh, on the technological side, you made those design mistakes, and so your blockchain is stupid. I don't know, man. They're just design decisions. They're not necessarily mistakes.
Max, I got a second question. So when I want to issue a bond, the side shift the side shift bond
Yeah.
where I need some cash and I'll pay it back over. It's crypto, so I'll pay it back over like 4 weeks.
Quick to pay back.
The timeline is a bit compressed in crypto. No, I'll pay it back over 2 years. What are my steps? What do I have to do? Like, what does PV01 vet? Like, what is the whole? I kind of start to finish.
So there's in that sense, some of it remains quite traditional. You've got salespeople going to the issuers, and that in TradFi it's called origination. So there's teams of people who are sort of have a close relationship with the issuers, and they know their financials well, even like private financials that not everyone sees, and they try to work with their needs in terms of capital structure to help them match those needs to whatever the investors might find palatable. So you know, it's going to be someone say, okay, you need money for 4 weeks. Are you sure it's for 4 weeks? You know, what about 3 months? Like, try to find why you think you need what you need, or maybe even come up with ideas that you hadn't thought of for ways to issue. Is there any security? Is there any asset that you can pledge to support your issuance, or no? Is it fully unsecured? So those guys work with you, and then at the same time, on the other side, there's people who know the investors well, and in a startup, it's the same people, right? I mean, at the end of the day, it's the same people. At the beginning, you know, what you would call credit sales, and then those guys know the investment strategies of the investors, what kind of debts they're interested in, what kind of companies they like to dig into, to do due diligence on. And then what happens is that when we identify some investors that would be interested in your debt, and that's what we call the primary process here, that's at the creation of the debt, that at the very beginning, then there's price talk, like how much interest, what the yield is going to be, and whether that works for the issuers and that works for the investors. And that's where there's a market. I mean, the market needs to find the rate that works for both sides. And then the things issued meaning that the tokens created, investors send USDC into the smart contract that goes to the issuer, and then the investors get the token in return, and then the bond is live. It comes with some paperwork that's, you know, there's just a link on the smart contract to some PDFs, right? And the bond is live. It legally it exists. It's valid. If you don't pay back, they can go to court and force you to pay, etc. And that's the primary process. And after that, there's the secondary market can emerge, meaning that investors, maybe you have you said 4 weeks, 2 years, who knows, but let's say 2 years, maybe the investors don't want to hold the bonds for more than 6 months, or they change their mind, and then they can sell it to someone else. But that market is the same as a market for tokens. You know, there's a token, you don't like it, you sell it. You want to buy it, you buy it, and vice versa.
Are you setting up your own markets for that, or are you going to use like the current on-chain protocols to swap the token back and forth?
I want to do both. I want to do both because I'm a dealer at heart. I like to make markets, so I would like to make markets in debt tokens. Of course, you know, for B2C2, it's very easy to make markets in debt tokens. Just you know, click a couple buttons and then boom, new token. For us, you know, we're a small company. It's not going to be as easy, but I like to think that I created B2C2 for a reason. It's because I'm good at making markets, and so I'll find a way. But other than that, and maybe this is not the most rational thing for me to do it myself, I also want to obviously use DeFi, because in fact, I think it might be like the bigger opportunity might be to use DeFi. And now it's going to be quite interesting because DeFi is not exactly entirely fit for purpose today for bond tokens. When you think about it, when you have a pool that represents two assets, one against the other, then it works well if you get like the top 20 tokens, because they're highly identifiable. There's not millions of them. But when you have debt, well, Microsoft maybe has 100 bonds outstanding, but there's only one share, one stock of Microsoft. So is DeFi going to lend itself to the potential complexity in terms of instruments? I think, technologically speaking, it makes no difference whether you're talking about trading one stock or 10 bonds. I mean, it's just a drop-down menu.
Yeah.
Who cares? With some autocomplete suggester, AI or whatever, a recommender AI. So I don't think it makes a big difference, but in the context of ERC20, it's a little bit sad that we have to create a new smart contract for every bond. I'm more interested in the future into those other protocols. Is it 1159, 1155, and a few others where it's kind of like a folder where the smart contract you can show different tokens under it. So you would imagine one issuer would be one folder, and then you would have all the bonds under it. That would be more interesting.
Like a multi-asset token.
Yeah, but before that,
it's on Ethereum though, right? Just like a different standard for Ethereum token. Yeah,
it's still on Ethereum. Yeah. But it's like NFTs are 700 something.
721. Yeah.
Well, 1155, I think.
Yeah.
Naturally, but I think, and that's a mistake that a lot of people in crypto make. They want the best technological solution, whereas like the best can be the enemy of the good here. You just want something that's adopted. And if MetaMask doesn't integrate with your thing, forget about it, man. It's you're failing. And so you want to do something that's easy to adopt, and then maybe the market will evolve to towards smarter ways of doing things. But that's how we're going to start. And the second thing that's not really ready in DeFi is that on a bond you have an interest rate, and it's not like the curve pool with USDT versus USDC. That stuff always should trade at one. But the bond, even if it's a completely risk-free government bond, or more or less risk-free, it shouldn't always trade at one because there's the accrual of interest.
Yeah.
And that makes it not exactly. I think we need to modify a little bit those apps to deal with that. But if we can do that, I think that's going to be a very good avenue, a very good way for the stuff to transact.
Yeah, that's pretty interesting. So do you have any timeframes on this? Like, do you know when the markets will launch, and are you onboarding companies that are looking to sell debt already, or is it mostly going to launch with, say, like U.S. Treasury bonds and like the bigger cap stuff?
Yeah, it's just a two-step process. First of all, at the moment, everyone in the crypto market is kind of scared of credit exposures. A lot of the stuff hasn't resolved. Even Genesis, their lending entity is in bankruptcy, but the trading entity isn't.
Yeah.
Really, the chips haven't all fallen. The dust hasn't settled, and so I think it's premature to think that crypto companies are gonna issue bonds. Maybe Binance could. But one issuer doesn't make a market. So we're starting with a treasury product in the course of the summer.
Okay.
All right.
Should be reasonably soon. A lot of other protocols do that already, and they're great. The difference for us is going to be transferable. So whether you can transfer U.S. Treasury, like, do you care? Really, it's going to be interesting when it's actual corporate bonds. And for that, so we're using treasuries to prove that the technology works, that it gets some traction in the market. But then, really, we want to issue corporate debt, and that's going to depend on the appetite of the market. It's not like a build it and they will come. It's also people need to be comfortable lending again to the most blue chip crypto companies, and that's going to depend on where on the current crypto winter.
Yeah. And I guess it'll be reflective on the rates that people are willing to pay in order to acquire this debt, right? Like obviously the higher rates, the less trust they have in the system overall. So yeah, it's a very interesting market.
Exactly. Now, and what I want blue chip stuff. I don't want convoluted, high yield, weird stuff that yields 30% a year.
Yeah.
I think, if you're looking at stuff that yields 30%, go do some liquidity mining, go buy some shit coins, if you create returns. What we think here is that the ability to put your money to work in a safe way, it's not like it's a human right, but everyone should have access to that. And so in an environment where rates are zero, no one cares that you're sitting on USDC and doing nothing with it. But when rates go to 3, 4, 5%, there's a real opportunity cost there.
Yeah.
And we know, all of us, we know that if you have a lot of money in crypto and you want to take it back, or even if you don't have a lot of it, if you have money in crypto full stop, you want to take it back to the banking system, almost impossible. And so like you could put your money in deposit for 4% now, but just moving it from USDC into actual dollars
Yeah, it's
is
difficult.
really tricky.
And I feel like it's going to get increasingly more difficult as the regulations increase. I mean, like the actions of the federal government in the past year, like some of it in my eyes is like super ridiculous. Like essentially blaming the banking crisis on crypto companies when they had absolutely nothing to do with like the internal workings of any of these banks, and then using crypto as a scapegoat, attempting to cut off fiat on ramps, off ramps for a lot of exchanges and a lot of individuals. Yeah, I feel like it's going to be more and more difficult to move even stable coins into fiat, and then
shame on them. Shame on them. And we're not criminals. We're not criminals. We just happen to want to put our money in stable coins or crypto. It's not a crime. And so the fact that we have a more limited access to very basic financial products, I think really irks me. I'm really mad about that.
Me too.
And so that's something that we hope to change, but not by creating something for the gens, but just basic investment products. U.S. Treasuries, Coinbase debt, stuff that yields 7%. Treasuries yield 5%. That kind of stuff. I want the big volumes.
Yeah, I mean, even like the smaller end retail user that like wants to get in crypto, but it doesn't want to be up like 20 hours a day, like swapping shit coins, trying to make it. Like they can invest in something that where they don't have to keep their money in like traditional banks, but they can also get the benefits of, say, like something as simple as a U.S. Treasury. Like you have U.S. dollars, you get paid to like essentially hold U.S. dollars, and you could do it all in like the whole blockchain decentralized experience. You can use self-custody, right? Like I think that's another big thing. Whereas like you don't have to trust like a counterparty, especially like the banking crisis gets a bit worse and more like regional banks start defaulting, then people are going to lose trust in that. But if your assets are guaranteed on chain, and then you hold the private keys, or you can figure out a self-custody solution, then that reduces the counterparty risk by quite a bit.
Yeah, and also, you shouldn't have 100% of your wealth in shitcoins. Maybe gamble 20% of it, and then 80% you should maybe use more sensible stuff. Just a bit of diversification, and also I think this is important for stable coins to grow in terms of usability. I think that like when you get stable coins, your first port of call, your first reflex shouldn't be to go and sell them for fiat. Should be to keep the stable coins. And pay your invoices, do stuff like that. And so having debt denominated in stable coins also is one way to get there, because if you have stable coins liabilities, then it makes sense for you to keep stable coin assets. Like it's on an equilibrium.
It makes sense. Like the more use cases you put on chain for stable coins, the more it makes sense to hold stable coins and use stable coins on chain. So like the more financial products there are that like interact with just holding a coin that's worth $1, the more it's going to be used for sure.
Yeah. So we'll see how it goes, right? We have a very good team here. We're very lucky to have done a funding round at the right moment on an idea that got traction. So now, we're a team of about 12 people now, I think. Lots of coders, some sales, some legal, etc.
Yeah, I'm looking forward to it. Andreas, do you have any questions?
No, the only thing I was wondering is which currency is the bond issued in, or whatever the term you would use for that is. Like, can I raise Ether or?
Yeah. So that the denomination of the bond.
Yes, that's what
Yeah, you can raise Ether. No problem at all.
Mm-hmm.
You have to consider now that people are going to ask why you need Ether specifically. If you can justify that, then if you're a market maker, it's going to clear why you need Ether.
Exactly. That was really my question, because I've been in this situation before. I mean, I asked you as well. I was like, hey, how do I get like random shit coins if I need it for the business I run? And you're like, well, normally you would just if you're an OTC desk, you go and borrow. And then it's like, okay, who will lend me a large amount of Litecoin? You're like, probably no one. So very interesting.
Well, what would be interesting would be to have the ability for the pools sorry, for the debt to be collateralized with different shitcoins, or coins, or not necessarily shitcoins.
Mm.
There's I used to work on that at Goldman actually. Tri-party repo. It's a neat system where you get cash, and what you pledge in return, you can switch in and out. In your collateral, you can very easily switch in and out. And so that would be a way to finance, whether it's Litecoin, whether it's Ethereum, whether it's Bitcoin. So we can envision at some point creating something like a tri-party repo facility. And really the debt capital markets are quite varied and quite deep. I want to start with the very basic unsecured bond that pays at maturity, super simple. But then after that, it can branch out into many, many directions. Yeah. What's really important is that, and I think this is also, it changes the game a little bit. When it was FTX doing lend, or Alameda doing lending, or are they different? Doing lending with a Celsius or Genesis, no one ever wanted to share their financials. They were very protective of those. And I think the reason was that you thought, well, really, I'm borrowing from Genesis, but Genesis is a competitor. I don't want them to see my private financials because they're going to use that against me in some other context. And I understand the sentiment, but at the same time, you can't have a debt capital market where everyone is guards their, keeps their cards to their chest. And I think that PVO1 being essentially like an advisor, like an investment bank to its clients, and having like some sort of, depending how, fiduciary duty, it's a different conversation. If we were to go to an issuer and say, look, we're going to help you issue debt, you can share your financials with us because we're not going to use them in any other context. We're not your competitor in any way. We just want to help you achieve your capital structure goals. And so that is going to make it easier to create a market at the juncture of debt investors, of which are going to be more and more, because all strategies in crypto stop working. So all the big funds in crypto are raising debt funds now. So at the intersection of debt investors and debt issuers, and when we have that, and it's not intermediated by people that are really competitors to one another, I think it's going to give us a much healthier ecosystem for debt in crypto.
Yeah, that makes sense. So before we let you go today, where can the viewers or listeners of this podcast either find you or say like updates on PVO1 or general stuff like that?
Easiest is the PVO1 Twitter. So PV01_market at Twitter. I'm also on Twitter, Max Boonen on Twitter, and you can follow me for sometimes crypto takes, sometimes spicier takes, which I like to offer from time to time. I don't know if that gets me more or less followers, but I don't give a shit. I'm gonna offer those takes whether the world wants them or not. Yeah, I like to tell it like it is. So you can follow me, Max Boonen, on Twitter as well.
And then the PVO1 Twitter is PV01 underscore markets. Okay.
Yeah. And we'll have links to all of these things in the episode. Don't worry about it.
Yeah, PVO1 was taken, which is a shame. Just like B2C2 was taken by a random guy with 2 followers. But I did manage to buy PVO1.ETH. Yeah.
Oh, so you got the ENS, nice.
I snatched it. It was very expensive.
Oh, really?
I think the shorter the name, the more expensive it is. There's some formula because it's 4 letters. But you got to spend money to make money.
That is true.
That's I think that's a good note to leave it at.
Yeah, I think that's all I have for today. I appreciate you coming on, Max.
Thank you, Max.
Thank you for having me. And Andreas, I look forward to seeing you soon.
That is true. I'll see you soon.